Welcome everybody to Safe Option Strategies presentation of Stock Market Basics. Getting started. This is the first class in the core Safe Option Strategies education, and the intent of this class is to lay the groundwork very simply for some other things that we'll be getting into and some other things that you'll be learning as you go through the Safe Option Strategies material. This is not a very long class. It's kind of an intro class, but let's go ahead and jump in and get rolling with this. This class is a production of Safe Option Strategies, and the content is protected by copyright. Any reproduction or redistribution of this or any Safe Option Strategies presentation is strictly prohibited by law. The information presented in this class is for education purposes only. Safe Option Strategies does not make any recommendation to buy or sell stocks or options. Trading stocks and options comes with risk, and you are solely responsible for any losses you may incur as a result of trading. All right, the basic things I want to cover in this class are, number one, the disclaimer that we just read. I'm going to explain, give me a moment, and I'm going to explain a little bit why we have that, how it protects us as a company, how it protects you, and the reason for that. We're going to talk a little bit about education versus advice, and that kind of goes hand in hand with the disclaimer. And we're going to talk about, generally speaking, option trading and how option trading is such an integral part of what we do. Now, some people join Safe Option Strategies because they love the idea of owning the stock, having long puts to protect it, having short calls to help pay for those long puts, and that's what they want their focus to be. And that's great, but you've got to learn options to do that. You're involving short calls, you're involving long puts in the process of or in conjunction with owning stock. Some people want to do option trading only in the way of spreads, and so we're going to talk about both. We're going to talk a little bit about why we use options, a little bit about how we use options, a little bit about what spread trading is all about, and I want you to know option trading does not have to be scary. Some people look at this program, and what might steer them away from it is that they're nervous about trading options. Option trading may not be for everyone, but it can be for everyone. And in my opinion, it should be for everyone, because option trading, in my opinion, is the safest way to be involved actively in the stock market. So we'll talk a little bit about that as well. So let's talk a little bit about the legal disclaimer. At the beginning of every presentation we do at Safe Option Strategies, whether you're listening to this as a recording, whether you're with us live right now as we're recording it, whether you participate in the live trading, the live chats, whatever part of this program you're participating in, we always start every presentation with that same legal disclaimer. And the main reason for it is this. I'm not a registered investment advisor. I have a registered investment advisor that I consult on a regular basis and who sometimes helps my students for little or no fee involved. But I'm not a registered investment advisor. No one that works for or is employed by Safe Option Strategies is a registered investment advisor. Okay? I cannot give individual one-on-one advice to people on how they trade. And the simple fact of the matter is, no matter what type of trade you set up, no matter how active you're involved in the markets, there is some risk involved with trading. Now, we often at Safe Option Strategies, we often talk about risk-free trades. There are some trades that for a period of time can be set up for little or no risk, but trading overall does not come without risk. There's no such thing as total, complete, 100% risk-free trading. It's important that you understand and know that. And when we start teaching some of the specific strategies, when we start getting into some of the individual plays that we'll do, we'll help you differentiate between a risk-free trade, which is still only going to be risk-free for a period of time, and sometimes we refer to things as theoretically risk-free. We'll explain that later on. But there's no such thing as total overall risk-free trading, and there are no guarantees. Now, we give a guarantee with this education. We guarantee that the trades that we send out each and every week are going to be profitable. The collar trades we do over a period of time are going to be profitable. But we cannot promise any specific profits or any specific returns on your investment. Sometimes it is a great accomplishment and it's a victory to not lose money. And a focus of a lot of what we do centers around not losing money. I think it's easy to make money once you learn to never lose money again. But no one can promise you a specific profit or a specific return on your investment. You need to be aware of that. Fear and greed are a trader's worst enemies. And I believe there is no way possible to trade with no emotion. When you hear someone tell you that they're going to teach you things that will take the fear out of trading, that will take away the greed from trading, I don't know how that's possible. I really don't believe it's possible. I get upset when I lose money. I am fearful of making a mistake that could cost me money. I don't think that's a bad thing if it is controlled. I don't think it's wrong to want to make a lot of money. Some people call that greed. I don't call that greed. I don't think it's wrong to want to be wealthy. You can do a lot more things when you're wealthy. But you've got to control that emotion and not let the desire to squeeze a little more profit out of a trade be what is ultimately controlling you. Fear and greed are a trader's worst enemies, and there's no way to trade without emotion, but controlling the emotion is crucial to making good decisions. Now, I want to swing back around to that legal disclaimer that I was talking about. The reason we have that at the beginning of every presentation, I told you part of that is because I'm not a registered investment advisor. Part of that also is to help you understand that you ultimately are the person in control of and the person responsible for every move you make. I can send out trades to all of my students every single week. And I do that with an understanding that you have the right to follow that trade in a virtual account. You have the right to follow that trade with real money. I cannot advise you to do it with real money, but you have the right to do that. Not every trade I place is profitable. The core of the Safe Option Strategies education is to put on low to zero risk trades in collars and to put on trades that can be adjusted when we do spreads. And sometimes the most well-planned, well-thought-out, best executed adjustment strategy is only going to lessen a loss. Some of our trades will lose money. Some of our trades do lose money. I want to be really polite and really kind about this. I don't want anyone that's hearing this class or watching this class for the very first time to second guess getting into this education. But I'm going to say it kind of, I want it to be polite, but I want it to be direct. Don't blame me if you lose money on a trade. I'm not advising anyone to put real money on trades. You're free to do that if you would like. I'm sending out trades that I'm placing or that someone in my company is placing. But you've ultimately got to know your risk. You've got to understand and know your limitations, and you've got to take responsibility. The reason our attorneys have over and over again advised us that we read that legal disclaimer every time we do a presentation, even though you may get sick of hearing it, is to remind people continually, we're not recommending that you buy or sell any stocks or options. We're showing you what we are doing. We're showing you what we think highly of. We're showing you how to do it. And that leads us to the other thing about education versus advice. The purpose of this company, the existence of this company, is to provide you with education, to teach you how to do things, when to do things, how to fix things. And I believe you've made a good decision to get involved in this education because we've gotten over the years very good at doing exactly that, teaching you what to do, when to do it, how to do it. Okay. Whoops, I went backwards there. Let's talk for a minute about stocks versus options. I know for a lot of you this is very, very elementary. For some of you, this is your first foray into options of any kind. You have a basic understanding of what stocks are. You've traded stocks yourself, or you've been actively participating with your broker in the process of managing a portfolio and trading stocks. But this might be your very first dipping your toe into the pool of options. So let's talk a little bit about stocks versus options. Stocks are real assets, and you need to never ever forget that. You actually have the right, if you choose to have a company that you own shares of. If you wanted to, you could have them issue you a certificate of stock ownership. And it's kind of like having a dollar bill in your pocket. It's kind of like having a coin in your pocket. It is a real, tangible asset. When you own a share of stock, you own a small piece of that company. Okay? The important differentiation between that and options is that options, you don't initially own any piece of a company when you buy or sell an option contract. You sign your name to a contract that gives you the right to buy something or gives you an obligation to buy or sell something, but you don't currently own anything when you go out and purchase an option. Now, think of this analogy. If you went out and bought a home right now, and for some reason your credit was so good, or you've just got a bank that's willing to give you a killer deal, you get an interest rate that's favorable to you, and you don't have to put one single solitary penny down on the purchase of that house. The bank is willing to write a check for the entire cost, give you the keys, you get to move your possessions in, you get to occupy that house and live in it, and you get to say that you're a homeowner. You can tell, you fill out another credit application, they ask you, do you own or rent? You get to say you own. But I want you to think about this. Do you really own that house, or does the bank own that house? The reality is you signed a contract agreeing to pay the bank over a certain period of time, a certain amount of money for ownership of that house. Technically speaking, you don't own that house. The bank does. Now, that may not be a perfect analogy, but I want you to remember that anytime you're thinking about an option contract, you have certain rights. The bank gives you the right to occupy that house. They give you the right to make home improvements. They give you the right to decorate it however you want. They give you the right to mow the lawn or not mow the lawn. They give you the right to park the cars you want in the driveway. You're buying the house. You've agreed to that. You have certain rights. But if you really get down to brass tacks on this, you do not own that house. The bank does. When you buy an option contract, you have certain rights, but you own nothing. And that's the big difference between stocks and options. Options were designed for protection. When they originally came about in the early 1970s, way before I was trading, I was born in the late 60s. So when I was still a kid, a young kid, a child, options became available for people in the stock market, and they were designed for protection. Very quickly, probably within days of people understanding and knowing how options worked and what they could be used for, people started using them for leverage instead of protection. And what happened is, with higher possible rewards came much, much higher risk. Let me give you a couple of examples. The risk to reward of options. When we are dealing with one option contract, it controls our rights or our obligations surrounding that option contract center around 100 shares of stock. So if I have one contract, one option contract that gives me the right to buy some shares of stock, one option contract is going to be for 100 shares of stock. Now, initially, the idea was you could hedge your risk by controlling the same number of shares for less money. Let me give you an example. Let's say I had $50,000 in my portfolio, and a company that I like, with our fictitious company XYZ stock, is trading at $50 per share. Now, I think the stock is going to go up in value. I think it's going to move up $5, $10 a share over the. I've done my homework. I've looked at some technical charts. I've done some fundamental analysis. I think the value of this stock is going up. I want to get 100 shares. At $50 per share, 100 shares is going to cost me $5,000. I'm going to invest 10% of my portfolio on this one position that involves 100 shares of stock. We're not talking about options yet. I'm talking about the first scenario. If the stock moves up $5 in price, I'm going to make a 10% return on my investment. ROI, if you're hearing it for the first time, return on investment. That's going to be my reward. If the stock price moves down $5, I'm going to lose 10% of my investment. So think about it this way. $5,000 is only 10% of my portfolio. A 10% return on that $5,000 is going to be a 1% increase in my overall portfolio. A 10% drop in that $5,000 is going to be a loss of 1% in my portfolio. Okay, that's not a horrible thing, right? Not a huge amount of reward to the upside, not a crazy amount of risk to the downside, but theoretically speaking, 100% of this is at risk. And let me ask a question for you now. Those of you that are with me live right now, you're welcome to answer. Play along at home if you're watching a recording of it. I'm just teasing. How far down would the stock have to move for me to lose 100% of my investment? How far down would that stock have to move for me to lose 100% of my investment? It'd have to go to zero, wouldn't it? Thank you. A couple of you answered. It would have to go all the way to zero. And that could happen. There's nothing to say that couldn't happen. Nowadays, it's kind of unlikely. Companies usually start to sell off and you see a lot of potential problems before they're just suddenly gone one day. But you've got to understand it could happen. Okay? Now, I could buy options. Now, here's the first scenario. Here's where we bring options into the mix. I could take that same $5,000 and an option might only cost me $5 per share instead of $50 per share. Remember, this is not a tangible asset. This is a contract that would give me the right to buy these 100 shares. But instead of spending $5,000, I would only have to spend $500. So one option contract, remember, controls 100 shares of stock. So these are the two different ways I can control 100 shares of stock. I can buy 100 shares for a $5,000 investment, or I can control 100 shares for a $500 investment. Now, the same move up in the stock price could result in approximately the same profit. If that stock went up $5 per share, like we were hopeful for, chances are I could make a similar return. It's not going to be exact because I'm going to have to subtract out some of the price of that option. Some of what I paid to, it's kind of like your interest in your, let's go back to the homeowner's contract. Let's go back to your mortgage. Your house might go up $10,000 in value the first year, and technically it's the bank's house, right? Technically it's the bank's house. Your house may appreciate in value $10,000, $20,000 that first year you live in it, but maybe you paid $3,000 in interest. So you're still going to see some equity in your house. You're going to see some profit, potential profit in your house, but it cost you a little bit because you had to pay interest. Same thing with this option contract. Because you paid for the option contract, that's like your interest on your mortgage. So the stock could go up $5. You're not going to make quite $5 because you got to subtract out of it the interest you're paying, or in this case, the price of the option, the price to be in that contract. Now, the same move down would result in approximately the same risk. But wouldn't you rather have only $500 at risk than $5,000? See the trade-off? Options were initially created to hedge risk. And this is what most people started doing immediately. They took that same starting scenario. They said, I can go out and buy 100 shares for $5,000, and if the stock moves up, I have my 10% profit, and if the stock moves down, I lose 10% of my investment. Now, I could control the same 100 shares for only $500, or I could spend the whole $5,000. I could spend the entire $5,000, and instead of just controlling 100 shares, I could control 1,000 shares because one option contract controls 100 shares. And if I went out and got 10 option contracts instead of one option contract, I'm controlling 1,000 shares for the same price I could have used to only have 100 shares. That's exciting, right? Because the same move up on the stock would actually result in a much higher return on my investment. I still have the cost that I got to pay to the bank, right? I still have that interest I'm paying. So I'm not going to make penny for penny profit as the stock goes up, but I've got 10 times the number of shares. So what if I give up 3 or 4 or 5% of that for the cost of those options? I'm making some really good money. Here's the problem. The same move down could result in losing the entire investment. Now think about this. In our first scenario, or even in this scenario, when we're talking about 100 shares of stock for a $5,000 investment, how far down did we say that stock had to go to lose all of this $5,000? The stock would have to go to zero, right? It would have to go all the way to zero to lose 100% of our investment. You know how far the stock would have to go down to lose 100% of our investment right here? If it went down and stayed down a few dollars a share, we'd lose it all. When options are used as a hedging mechanism, they're exactly that. They protect you. There's a small price to pay for insuring something. There's a small price to pay for controlling the same number of shares for a lot less money. When options are used for leverage, there's a potentially much higher reward. What comes with that is a much higher risk. One of the reasons we spread trade, now I'm not going to get into specific strategies right here, but spread trading is a term you're going to have to become very familiar with. One of the reasons we spread trade is because it gives us the ability to have the leverage of options and remove some of the risk, not all of it. Go back to what I said earlier in this presentation. There is no way to completely 100% eliminate the risk from trading. But a spread trade gives us the ability to not only hedge our risk going into the trade, but it gives us the ability to adjust trades, and it takes away a lot of that risk. So we retain the higher reward, we get rid of the higher risk. What could be better than that, right? Spread trades can be incredibly simple, or they can be very complex and involve as many as 6 or more different option legs. We're going to go through almost every strategy that you can think of through this education, and more specifically, when to use them and how to adjust them. And that's the key to everything we're going to do over the course of this education, is teach you how to adjust trades. I want to talk a little bit about due diligence. Yeah, that's a term that gets thrown around so casually nowadays that we sometimes, it's almost easy to forget what it actually means. Due diligence, most simply put, is doing your homework, doing the necessary research to make an informed decision. I had a boss years ago, before I owned my own company. I had a boss that used to, you know, I was in sales and I was a manager at a company and had several salespeople working for me. And my boss, who was the owner of the company, used to say, he used to teach me and teach some of his other salespeople, when a person is leaning towards saying no to something you're trying to get them to do, one of the best ways to get them to think a little bit harder is to say to them, you haven't got enough information to be in a decision-making posture. And that was his clever little term. I liked it. I'm not saying that in a negative way. You don't have enough information to be in the correct decision-making posture. What he meant was, if you want to simplify it, you haven't done your homework yet. You're saying no because you heard the price of something. You're saying no because it sounds risky. You're saying no because I don't look as good as that other sales rep that was in your office a month ago. You're saying no because your bosses are telling you we don't have the budget to do anything different. But the reality is you don't have enough information yet. You haven't done your homework. You shouldn't be making a decision yes or no until you've done your homework. That is so applicable to any type of trading that you are doing. Due diligence, perform your homework. Take the time to research things. You don't have to become a scientific researcher like a kid in college trying to pass a class. You don't have to be like a rocket scientist at NASA or Boeing or General Dynamics who's you know, building the next spaceship. But you've got to do some homework. You should know the companies you're trading. One thing that you'll see that is going to be different as you progress through this education, something you're going to see that may be very different from other things you've participated in or other things you've done, is that we don't run stock screening programs and just trade whatever ticker symbol fits into a certain parameter, whether we know the company or not. We trade companies we know. Knowledge is power. I absolutely believe that. And it is very applicable to everything that we're going to do. We will teach you how, if you're not already an expert at this, don't worry. You need to understand some basic information about patterns and trends in stock prices, how to read a stock chart, what information to set up your stock chart with. We have a class coming up in the education that's dedicated 100% to that. And as it relates to the companies that you're trading, if you haven't been this way in the past, I want you to become a news junkie as it relates to the companies you trade. And in addition to that, learn to discern what other news events affect the markets generally and the companies you trade. Let me give you an example. If I'm going to be a news junkie and I trade Apple stock, I use an iPhone, I have a MacBook, I wear an Apple Watch, I know the company. I need to know a little bit. I don't have to go out and get a PhD in accounting or a master's degree in accounting, but I need to know a little bit about the numbers that company drives. Are they making money quarter after quarter? Are they making money year after year? How much cash do they have? How much debt do they have? When a competitor does something big, how might that affect Apple stock? If Samsung comes out with a new phone ahead of their projected launch date, what does that do to Apple's company? What other articles? How involved is Tim Cook, the current CEO of Apple, getting in politics? How involved is he getting in social issues that may not seemingly have a lot to do with whether iPhones are going to sell more this month or less this month? But if it's news that relates to that company and if it's news that can drive the price of that stock, I need to be aware of it. And then I need to broaden out just a little bit and say, what other news events can affect the markets generally? What if there was a major breaking news story about China's economy and it never mentioned Apple, it never mentioned cell phones, it never mentioned any of Apple's competitors, but some news broke that China has just somehow broken the mold on expansion in their GDP, and they're bringing millions of people of their population out of third world poverty, and something incredible is happening. Do you think there's a chance, with having recently gotten into China, that iPhone sales might go up a little bit and that could be good news for Apple? Let me give you, at the time we're recording this, let me give you a real example. That's kind of a hypothetical. Let me give you a real example. There's a company in China called Baidu. Some of you know who they are. Some of you have traded them. They're on the Safe Option Strategies watch list. Baidu, this might not be a perfect example, but Baidu is kind of like China's version of Google. The Chinese government is still really restrictive on what they allow coming in on internet in their country. But Baidu is kind of their version of Google. And it's a big company, and it's a profitable company, and it's an expensive stock. Not quite as expensive as Google, but it's not a cheap stock. Netflix, the company that, whether you use them or not, everyone knows who Netflix is, the streaming videos and TV shows and movies and all that stuff on your TV or your phone or your tablet device, whatever it is. Netflix recently struck a deal with Baidu to start introducing a lot more content to the Chinese population. Guess what Netflix stock did? It jumped up. Now that's a news event that specifically relates to the company, but it also has this broader global aspect. You've got to become a news junkie as it relates to the companies you trade, and then figure out which news events are going to affect the markets generally in the companies you trade. If you've got several oil companies in your portfolio, if you're trading ExxonMobil and Chevron Texaco and maybe ConocoPhillips, and Iran decides that they're going to increase oil production, even though they previously agreed that they would scale back on it to help keep the price per barrel of oil stable, and all of a sudden Iran starts flooding the market with 10 times what they said they were going to, it's going to have an effect on the companies you trade. Even though that's a news story that may not mention ExxonMobil, it may not mention Chevron Texaco. Okay, Let me tell you a couple websites that I use. You should explore and use whatever websites you want to. I love stockcharts.com. We're going to, in one of the upcoming classes on technical analysis, I'm going to show you exactly how to set up stockcharts.com if you want to look at charts that are a perfect mirror of how I set up my charts. Because when you get email alerts and when you get updates and when you see things on our website, you're going to see screenshots from stockcharts.com. I like finance.yahoo.com, largely because I'm so familiar with it. I've used it for so long that I know even when they make changes to their website, it's not hard for me to find information I'm looking for. But there's other good sites. Bloomberg, Google has a finance page. If you use any Quicken products like QuickBooks or anything like that, Quicken, investing.quicken.com has some good tools. MoneyBlock is a website that I like some of their tools. You don't have to have an account with them to use some of their tools. And these last two are broker websites. I put these up here purely for example's sake, but you need to thoroughly explore all of the tools for research that are available on your broker's website. Whatever broker you might be using, get as familiar as you can with their tools. I'm going to talk more about that in just a moment because now we're going to move into picking a broker. If you don't already have a broker that you use online and that you like, here's a couple of things to help you choose. I'm not going to choose a broker for you, but here's a couple of things to help you choose. Not every broker knows options and spread trading well. Do a little bit of research and find a company that is very, and when I say they don't know them very well, I'm talking about the frontline customer service people. When you dial the phone and you need help placing a trade or you need help understanding your max profit or your max loss in an open position you need someone who understands options and spread trading very well. Do some research on that. Not every broker is as easy to work with. When I say not every broker will work with you, every broker that's online has to have a customer service presence, but not every one of them are easy to work with. See how they're rated. See what other investors are saying about the broker that you're thinking about using. And then see how much they'll let you explore and use the tools that they have. I've been with Options Express for years. They're not the only broker I recommend. I like them. I like them mostly because for me, I understand their platform. I know where everything is at. I know how to find my way around and navigate my way around real easy. I think the information they have is easy to read and understand, but they won't do some things that Thinkorswim will do. Now, this is a real example, by the way. I really like Thinkorswim. They have some tools and they will do some things that Option Express can't do. But I've never taken the time to learn those things and get good at them. It's kind of like, to me, it's kind of like driving a car versus driving a spaceship. Sounds really cool to drive a spaceship, but I don't know how. Doesn't mean I couldn't learn if you make it easy enough. But experiment with some different brokers. A lot of brokers will let you open up a dummy account or a virtual account and play around with their tools to see what is easy to use and what is not. Find a broker you can afford. Not every broker has the same commission structure. Thinkorswim Interactive Brokers has some of the smaller commission structures for investors that are starting out and trading with smaller portfolios. So they might be a little bit easier on your wallet. Options Express, I told you I really like their tools. They're a little more expensive for smaller numbers of contracts. It kind of evens out if you ever get to the point where you're dealing with 10 or more contracts on the majority of your option trades, it kind of evens out. But for smaller numbers of contracts, they're kind of expensive. So find somebody that you can afford. And sometimes affordability has less to do with price, and it's more about, do I like these guys enough to justify the price? These are just a few brokers that I have confidence in. These are not the only ones, and these are not in a specific order. Options Express, MoneyBlock. The reason I like MoneyBlock, and I have them on this list, they're not as well known, they're not as big, but they were started, or at least they're managed by some people that were with Options Express before Schwab took over Options Express. This name could be going away in the next 6 months to a year and will be replaced by the Charles Schwab name. What is that? SCHWAB. Whoa, they're owned currently by Schwab, and I think there's a chance. I didn't spell that very good on there, but I think there's a chance, or at least I've heard rumor that the Options Express name is going away and it'll just become Schwab's platform, which is fine if they keep their tools the same and keep their commission structure the same. That's not going to bother me, but it's just something to be aware of. MoneyBlock is being run now largely by people who are a part of starting up and running Options Express in its early days. And so that's why I like MoneyBlock. Thinkorswim is a great platform, very trusted, very robust in terms of their tools, a little more complex to use, but they've got really well-trained people there that know their stuff, a great customer service. Interactive Brokers is growing. They might be the fastest growing online brokerage right now because they have such a vast international platform. If you're uncertain, if you're in a foreign country and you're a member of Safe Option Strategies and you have not already settled in on a broker, I would urge you to check out Interactive Brokers. They have platforms that work in almost, well, I got to be careful not speaking absolutes. I know they work in a lot of countries around the world and allow you to trade the US markets through those countries. I'm going to wax philosophical for just a moment. I won't take a lot of time on this right now because you're going to hear me talk about this at other parts of this education. A lot of traders cannot see the forest through the trees. Everyone's heard that analogy, you can't see the forest through the trees. And I love that analogy because if you're in an airplane or if you're up on top of a mountain or high up on a trail and you can see above the level of the trees, you have a picture of the forest that's very unique. You can see where it ends. You can see where a river might cut through the middle of the forest. You can see where the next mountain range starts up. You can see where you can see areas that you should maybe avoid and see areas that might be a little bit safer. There's an amazing advantage to having a view from above. What happens a lot of times in trading is that we're standing on the ground and there's this huge redwood or sequoia tree right in front of us. It may be something like a broker that we're not getting good answers from. It might be, I jumped in the Safe Option Strategies program and the very first trade I decided to place had to be adjusted and the adjustment only got us to a lesser loss, but we still lost money. And all of a sudden that tree that represents that trade blinds you and blocks your view of everything else that's out in front of you. You can't see the forest because you're standing there looking at the tree. When it comes to trading stocks and options, we don't have to have the physical capability to scale a mountain. We don't have to have the money to get in a plane and fly somewhere. In our mind, we can back up to that forest view. We can zoom out and say, okay, I can't let this tree in front of me keep me from seeing the big picture. I've got to remember. Now, there are times when I need to focus on that tree because that tree may be blocking my path and I've got to get it out of the way before I can get back to seeing the forest. That'll happen sometimes. I'm not saying you ignore every tree in your path because if your mind is constantly focused on the forest view, you might run head on into the next tree and it'll knock you out and you'll be laying flat on your back. I'm speaking metaphorically, of course. There are times when you've got to address that tree that's in front of you, but you've always got to maintain the psychological, the mental, emotional ability to back up, zoom out, and see the forest. When you learn to focus on the trees when the time is right and to back out and look at the whole forest when the time is right, trading is going to become less stressful. It's going to become more enjoyable. The homework and your discipline to things you learn are going to be your two best friends when it comes to trading. And I would say they're going to be your two best friends when it comes to controlling your emotions while you're trading. And I'm going to tell you this. This is the best piece of advice I could give anyone who is starting out in the markets, managing their money themselves for the first time, or starting this education for the first time. If you're ever in serious doubt about something, walk away from it. If you've gone through several classes about the bull call spread and how to adjust the bull call spread and when the right timing is to use bull call spreads, and you do some homework and you do some analysis and you're just still not quite sure, there's still some lingering doubt, It may be doubt about whether you've picked a good company. It may be doubt about whether the timing is right. Maybe you're doubtful about your ability to make the right adjustment at the right time. Whatever the case is, if you're in doubt, walk away. Now, that doesn't mean you, at some point in time, you don't have to take some risks. There's a difference between being in doubt and just being afraid. I'm going to help you get past the fear, but trust your gut. And if you're seriously in doubt about something, or if there's just that nagging feeling that something's not quite right about this trade, walk away from it. You'll never lose money when you don't place a trade. Always keep that in mind. Folks, that wraps up our first class in the Safe Option Strategies program, Getting Started. Thank you for joining us today. Thank you for your participation. For those of you that were here live, for those of you that were listening to this as a recording, if you have questions after listening to this as a recording, please email them in to us, and we'll do everything we can to get back to you as quick as possible. Thank you, everyone, and have a great day. Bye-bye.